Imagine spending billions on AI chips, servers, buildings, and engineers, then discovering the real blocker is electricity. That is why some AI companies are buying, contracting for, co-locating with, or helping finance dedicated power generation. Not because software stopped mattering, software matters, but at AI scale, software cannot run without physical power. This video answers one direct question: why some of the biggest AI companies in the world are buying their own power plants. And the answer is not just about technology. It is about business, energy, capital, and national infrastructure. A finished AI data center can still be delayed if it cannot get reliable electricity at the required scale. That is the detail most headlines skip, because electricity sounds less exciting than artificial intelligence. But when electricity becomes scarce at the right location, it becomes strategic. Here is the simple version. AI companies are not only competing for better models and faster chips, they are competing for the physical ability to run those chips continuously, reliably, and economically. Quick boundary before we go deeper. This is educational analysis, not financial advice, and not a recommendation on any stock or sector. This video is also not arguing that AI is bad or that data centers raise electricity prices everywhere. The accurate claim is narrower and more useful. AI infrastructure creates large, concentrated electricity demand in specific places. When that demand arrives faster than the grid can expand, companies start looking for power outside normal utility timelines. And this is where it gets genuinely interesting. In normal consumer technology, the bottleneck is usually product adoption. Can people use it? Do they want it? In AI infrastructure, the bottleneck can become a substation, a transformer, a gas turbine, or a grid connection approval. That sentence sounds boring until it blocks a project worth billions. The first thing to understand is this: AI does not live in the cloud in any physical sense. The cloud is a building filled with servers, connected to wires, cooled by equipment, and fed by electricity. If the building cannot receive power, the cloud does not compute anything from that location. So the mystery is not why AI uses electricity. That point is obvious. The real mystery is why some of the richest companies in history are moving closer to the energy business. Why are technology companies signing long-term nuclear agreements, backing geothermal projects, and exploring on-site generation? Why would a software company care about interconnection queues, grid capacity, and megawatts? Because the most advanced chip in the world is still a load on an electrical system. The chip may be extraordinary. The plug is still very literal. And that is the entire video in one sentence. The AI economy is being shaped by the physical infrastructure required to operate it. Once that becomes clear, the power plant deals stop looking strange. Start with a basic data center. It is not one computer in one room. A large AI data center is a dense industrial facility that can contain thousands of servers running high-performance chips. Those chips consume electricity, produce heat, move data, and require cooling systems that also consume electricity. The demand is not spread gently across a country. It appears as a large load in one location. That location then needs generation, transmission, substations, transformers, switchgear, backup systems, cooling, and maintenance. In a normal office building, electricity is one component of the operating cost. In an AI data center, electricity can decide whether the facility operates at the intended scale. That is a different business reality. The IEA reported in April 2026 that data center electricity demand rose 17% in 2025. In the same year, global electricity demand grew 3%, according to the same IEA analysis. The gap between those numbers is the first clue. Data centers are not the whole electricity system, but their growth rate is unusually fast. And the AI-focused facilities inside that category are growing even faster. The IEA also reported that electricity consumption from data centers is set to double by 2030. It said power use from AI-focused data centers is poised to triple over that same broad period. Those are projections, not certainties, but they explain why companies are acting before the grid is ready. Nobody wants to spend years securing chips, talent, customers, and land, then wait for a transformer. That is not a dramatic villain. It is a procurement problem. And procurement problems can become strategy when the scale gets large enough. The IEA also pointed out something that makes the story more nuanced. Power consumption per AI task is declining rapidly because efficiency is improving. That sounds like it might solve the problem, but demand is growing at the same time. More people use AI tools. More companies integrate AI. More applications run continuously. Efficiency can reduce the electricity used per task, while total use can still rise. This is one reason the debate gets confused. One side says AI is becoming more efficient. That can be true. Another side says AI electricity demand is rising. That can also be true. The conflict is not in the facts, it is in the level of analysis. Per task efficiency and total system demand are different measurements. Think about what that actually means. A car engine can become more efficient, while a city still uses more fuel because more cars are driving. That is not a perfect comparison, but the arithmetic logic is direct. The AI build-out has a similar pattern. Efficiency improves, adoption expands, and total infrastructure demand can still increase. This is why the serious question is not whether AI uses electricity. The serious question is whether electricity can arrive in the right place, at the right scale, on the required timeline. That is where the business story begins. A public electricity grid is not a single battery that companies can pull from whenever they want. It is a network of generators, transmission lines, substations, distribution systems, markets, regulators, and reliability rules. When a new data center wants a large connection, the utility or grid operator has to study the impact. Can the local network handle the load? Does new transmission need to be built? Does the substation have enough capacity? Are new transformers needed? What happens during peak demand, extreme weather, or equipment failure? These are not philosophical questions. They are engineering and reliability questions, and the answers can take time. The IEA noted that planning, regulatory systems, grid connections, and necessary approvals are slowing some data center projects. It also noted tight supply chains for gas turbines, transformers, advanced chips, and other energy or IT components. This is where most people miss the real story. AI infrastructure is not delayed only by one scarce item. It can be delayed by multiple scarce items arriving in the wrong order. A company may have the land, but not the grid connection. It may have the grid agreement, but not the transformer. It may have the building plan, but not the generation capacity. It may have the chips, but not the cooling infrastructure ready on ton. Large infrastructure is sequencing. One missing component can slow the usable output. This is why some AI companies are not waiting passively for the grid. They are signing power purchase agreements, supporting nuclear restarts, exploring advanced reactors, backing geothermal projects, and studying on-site generation. The common theme is not that many of them want to become utilities. The common theme is that electricity access has become a constraint they cannot ignore. Here is what makes data centers different from many other industrial loads. They can be massive, concentrated, and highly sensitive to delay. If a factory waits for electricity, production is delayed. If an AI data center waits for electricity, compute capacity is delayed. And compute capacity can be directly tied to product launches, cloud contracts, model training, and enterprise demand. This is why a grid queue can become a business risk. The boring input becomes the decision point. That line is dry, but it matters. Modern capitalism is full of exciting front-end products that depend on unexciting back-end constraints. AI is making that visible in real time. A model can be announced in minutes. A transmission upgrade can take years. Those two timelines are now colliding. The next layer is capital. AI infrastructure is not just expensive, it is capital intensive before revenue is fully certain. The IEA reported that 5 large technology companies spent more than $400 billion in capital expenditure in 2025. The same IEA analysis said this figure was set to increase by a further 75% in 2026. That does not mean each dollar goes only to data centers, and it does not prove future returns. It does show the scale of the infrastructure race around AI. When capital spending reaches that level, electricity stops being a side issue. It becomes an element of the investment thesis for the infrastructure itself. A data center is not valuable just because it exists as a building. It is valuable when it can host compute, receive power, stay cool, connect to networks, and serve customers. Remove the electricity, and the building becomes a very expensive shell. That is the blunt business reality. Now connect this to financing. A large data center may involve land purchases, construction costs, server procurement, cooling equipment, network infrastructure, and long-term power contracts. Each cost is linked to a different market. Interest rates affect financing. Commodity prices affect equipment. Regulation affects approval. Energy markets affect operating economics. This is why AI infrastructure is a macroeconomic story, not just a technology story. The data center sits at the intersection of money, energy, real estate, commodities, and geopolitics. Nobody talks about this layer enough. A chatbot looks simple because the user interface is simple. The infrastructure behind it is not simple. That is where the biggest misunderstanding begins. People see a prompt box and assume the business is mainly software. The prompt box is the piece the user touches. Behind that are chips, power contracts, cooling systems, construction schedules, utility negotiations, and financing decisions. For a small application, software can dominate the story. For large-scale AI, infrastructure starts taking a larger share of the conversation. And this is why power plants enter the picture. Not because technology companies woke up one day and wanted to run energy assets for fun. Because the energy input became too important to leave to ordinary timelines alone. That is the business behind the headline. This is also why macro matters here. I've built the Applied Macroeconomics course for viewers who want to understand this wider architecture. The curriculum covers money, central banking, credit, inflation, interest rates, sovereign debt, global macro, commodities, hard assets, geoeconomics, trade, cycles, market psychology, and future monetary architecture. If this kind of analysis is useful to you, the course link is in the description. Now come back to the main story, because the power deals are where the trend becomes concrete. The first deal to understand is Microsoft and Constellation. In September 2024, Constellation announced a 20-year power purchase agreement with Microsoft. The deal was tied to restarting 3 Mile Island Unit 1 as the Crane Clean Energy Center. Constellation said the restart would add approximately 835 megawatts of carbon-free energy to the grid. The plant is expected to be online in 2028, subject to nuclear regulatory approval and other permits. That detail matters. This is not instant electricity. It is a long-duration infrastructure process with safety review, investment, equipment work, and regulatory conditions. The point is not that Microsoft bought a switch and turned on a plant. The point is that a major technology company signed a long-term agreement tied to bringing major generation capacity back. That is a very different energy posture than simply paying a monthly electricity bill. Then look at Google and Kairos Power. In October 2024, Google announced an agreement to purchase nuclear energy from multiple small modular reactors developed by Kairos Power. Google said the agreement could enable up to 500 megawatts of new round-the-clock carbon-free power by 2035. The initial phase is intended to bring the first reactor online by 2030. Again, this is not a quick fix. It is a long-term bet on a new generation pathway for electricity supply. And the reason it belongs in this video is simple. Google connected the agreement directly to electricity needs for AI technologies and data centers. The third example is Amazon and Talon. In June 2025, Talon announced an expanded nuclear energy relationship with Amazon. Talon said the power purchase agreement would provide 1,920 megawatts of carbon-free nuclear power at full contract quantity through 2042. The delivery is expected to ramp over time, with full volume expected no later than 2032. Talon also said the agreement supports Amazon operations tied to AI and cloud technologies in Pennsylvania. Notice the pattern. These are not small office supply contracts. They are long-duration energy relationships tied to major digital infrastructure. Then there is Meta and Constellation. In June 2025, Meta announced a 20-year corporate nuclear energy agreement with Constellation. Meta said the Clinton Clean Energy Center agreement would provide 1,121 megawatts of emissions-free nuclear energy. Meta also said it continued to evaluate new nuclear projects to meet a 1 to 4 gigawatt target. The direct business logic is visible. AI data centers need reliable electricity. Nuclear plants can provide firm power. Long-term contracts can support investment. That does not mean nuclear solves the whole problem. Nuclear projects can face cost risk, construction risk, regulatory risk, public acceptance risk, and long timelines. But it does explain why major technology companies are paying attention. They are looking for power sources that can support large, continuous loads. Wind and solar matter too, but they are variable without storage or complementary generation. Natural gas can be dispatchable, but emissions and fuel price exposure matter. Batteries can help with flexibility, but they do not create primary energy on their own. Geothermal can offer firm, clean power in suitable locations, but scaling remains project-specific. The honest answer is that each power source has trade-offs. That is why this is not a one-solution story. It is a portfolio and timing story. The AI company needs power at the right time in the right region with the right reliability profile. If that power is delayed, compute is delayed. And if compute is delayed, business plans can change. That is why the power agreements matter. They are not decorative sustainability announcements. They belong inside the infrastructure strategy behind AI capacity. Once you see that, the title makes sense. Some AI companies are buying, backing, or contracting for power because electricity has become a competitive input. The word buying is shorthand. The real structures are contracts, ownership, co-locations, and financing relationships. Now, the obvious question becomes, why not just buy electricity from the grid? In many cases, that is exactly what data centers do. Most companies still rely on utilities, grid markets, corporate power agreements, and standard interconnection processes, so we need to be precise. This video is not saying AI companies have abandoned the grid. The better statement is that some major AI infrastructure players are adding dedicated power strategies because ordinary grid access can be too slow or uncertain. A grid can be reliable for existing demand and still struggle with rapid new concentrated loads. That is not a contradiction. If a city is built for one level of demand, a sudden new industrial load changes the planning problem. Utilities then need to study whether new generation, transmission, or substation capacity is required. Regulators may need to approve cost recovery. Local communities may raise land, water, noise, or environmental concerns. Suppliers may need to provide equipment that has long manufacturing lead times. And the data center operator may not want to wait. Here is what most people miss. In AI infrastructure, waiting can have a real opportunity cost. If demand for compute is high and capacity is scarce, the facility that comes online earlier can capture business earlier. That does not promise profit. It simply explains why timing matters. In a normal office lease, a 1-year delay is painful. In an AI build-out, a 1-year delay can affect model training schedules, cloud contracts, and customer commitments, so companies look for ways to reduce timeline risk. One method is co-locating data centers near existing power generation. Another method is signing long-term power purchase agreements. Another method is supporting new energy projects that would not move as quickly without a creditworthy buyer. Another method is exploring on-site generation, where grid connection is constrained. Each method has different economics and legal structure, but they share one goal: reduce uncertainty around electricity access. That is why the phrase "buying power plants" needs careful handling. Sometimes the company may literally acquire a campus near generation. Sometimes it may buy the electricity output under a long-term contract. Sometimes it may help finance future capacity by being the committed buyer. Sometimes it may support generation indirectly through environmental attributes or grid-connected structures. The literal forms differ, but the economic reason is similar. AI compute needs power certainty, and the market is learning that power certainty is not automatic. The next question is what kind of power AI companies actually want. The simple answer is reliable power. The more complex answer depends on cost, carbon goals, location, regulation, and timeline. Start with nuclear. Nuclear is attractive because it can produce large amounts of firm electricity with low operational carbon emissions. That is why Microsoft, Google, Amazon, and Meta have each explored nuclear-related agreements in different forms. But nuclear also has hard constraints. Large nuclear projects can take many years, require intense regulatory review, and carry construction and financing risk. Small modular reactors may reduce some challenges if they commercialize successfully, but many projects are still early. So nuclear is powerful in the thesis, but slow in execution. That sentence matters. The AI industry often wants capacity quickly. Nuclear development often moves carefully and slowly. That is why existing nuclear plants are so valuable in this conversation. Restarting, preserving, or expanding existing facilities can sometimes be more realistic than building brand new large plants immediately. Now look at natural gas. Natural gas plants can provide dispatchable power, meaning output can be adjusted to meet demand. That can be useful when data centers need reliable supply and grid connections are delayed. But gas has fuel price risk, emissions concerns, permitting issues, and long equipment supply chains in some markets. The IEA specifically noted tight supply chains for gas turbines. So even the faster option can hit equipment limits. Then there are renewables. Solar and wind can be built faster than many thermal power projects in suitable regions. They can also align with corporate carbon targets. The IEA reported that the tech sector accounted for around 40% of corporate renewable power purchase agreements signed in 2025. That is a major signal of demand. But solar and wind output varies with weather and time of day. A data center that needs round-the-clock power cannot rely on variable output alone without storage, grid balancing, or complementary generation. Batteries help with flexibility. They can shift energy across hours, respond quickly, and stabilize certain loads. The IEA noted that on-site battery storage is becoming critical for the next generation of AI data centers. But batteries are not magic electricity sources. They store energy that was generated somewhere else. That makes them useful, but not a substitute for primary generation. Then there is geothermal. Advanced geothermal is attractive because it can potentially provide firm, clean power in suitable geologies. The challenge is that geothermal depends heavily on location, drilling performance, financing, and project execution. It is not a universal plug-in solution. That is the pattern across energy sources. Nuclear is firm but slow. Gas is dispatchable but exposed to fuel and emissions issues. Renewables are scalable but variable. Batteries are flexible but storage-based. Geothermal is firm but location-sensitive. The serious conversation is not about one perfect answer. It is about matching energy sources to the actual needs of data centers, grids, regulators, and communities. This is where the AI story becomes an energy system story. A model can be updated quickly. Energy infrastructure usually cannot. That mismatch is the central tension. There is one distinction that changes the whole topic. Installed capacity is not the same as available power for a specific data center. A country may have large total electricity generation and still lack capacity in the exact location a data center wants. A region may have renewable energy available during some hours and still need firm supply during other hours. A grid may have generation on paper and still need transmission upgrades to deliver it. A power plant may exist and still need contracts, regulatory approval, or interconnection work before it supports a specific load. This is why broad electricity statistics can be misleading when used alone. The local delivery problem matters. For AI companies, the question is not just whether the country has electricity. The question is whether the specific site can receive enough reliable power on the business timeline. That is where data centers start competing with other loads. Homes need power. Factories need power. EV charging needs power. Manufacturing reshoring can need power. Electrification of heating and industry can also raise electricity demand in certain markets. A data center enters that system as another large user. The public debate often turns this into a moral argument immediately, but the first layer is an allocation problem. Who gets capacity, who pays for upgrades, and how reliability is protected? Those questions matter for households, utilities, regulators, companies, and investors. And I want to be precise here. A data center can create local costs and still create local benefits. It can increase electricity demand and still support jobs, taxes, grid investment, or new generation. It can stress infrastructure and also create demand signals for infrastructure expansion. The earnest analysis has to hold both sides at the same time. That is why lazy commentary fails here. It either says AI data centers are purely destructive, or it says market forces can fix the issue immediately. The evidence supports a more serious view. Data centers can create local challenges, and policy designing can change how those costs and benefits are distributed. That is the level where the real debate happens. Who pays for the grid upgrades? Who receives the electricity? Who receives the jobs? Who carries the reliability risk? Who captures the compute value? Those questions are not anti-technology. They are the normal questions society asks when one industry starts demanding a larger share of critical infrastructure. AI has now reached that point. The United States appears heavily in the examples because many public AI power deals are there, but the underlying issue is global. Data centers are expanding in regions with different electricity prices, permitting systems, land availability, water constraints, and grid structures. Some regions have cheap power but weak transmission. Some have strong grids but expensive land. Some have clean power goals but slow permitting. Some have fast construction timelines, but political or regulatory uncertainty. This is why AI infrastructure is unlikely to spread evenly across the world. It is likely to cluster where power, data connectivity, regulation, land, and customers align. That clustering can create economic advantages for some regions and pressure for others. A country that can deliver secure, affordable, rapid electricity access may attract more AI infrastructure. A country that cannot may participate more through software, services, data, or downstream applications. This does not mean one country automatically wins. It means energy systems become a component of digital competitiveness. That is a major shift in how people can think about AI. AI is not floating above geography. It is being placed on land, connected to grids, cooled with physical systems, and financed through real capital markets. Geography matters. Energy policy matters. Interest rates matter. Commodity supply chains matter. Regulation matters. That is why the title is not just a catchy phrase. AI companies are buying their own power plants because the location and availability of power can shape the economics of AI. Companies do not use one format for this. Some may sign long-term contracts. Some may partner with utilities. Some may use renewable PPAs. Some may explore nuclear. Some may use grid power with better rate design. Some may develop on-site gas generation where regulation allows it. The form depends on region, policy, technology, and business need. But the direction is clear enough to study seriously. Power access is becoming an element of AI strategy, not as a slogan, as an operational constraint. And constraints reveal what companies really value. Now we need to talk about electricity prices without exaggerating. It would be inaccurate to say data centers automatically raise electricity bills everywhere. The IEA explicitly notes that higher electricity demand does not necessarily raise prices if the right policies and infrastructure are in place. That is an important safeguard. But it would also be inaccurate to pretend there is no affordability issue. Large, concentrated loads can require new generation assets, grid upgrades, and planning changes. Somebody has to pay for those systems. The policy question is how costs are allocated. Is the data center paying more directly for upgrades it triggers? Are costs being spread across customers? Are utilities creating special tariffs for large loads? Are data centers required to provide flexibility during grid stress? Is on-site generation encouraged, restricted, or priced differently? These are not simple questions. They also differ by country, state, province, and grid market. That is why a global video has to avoid one national answer. The US case is useful because the data is visible and the build-out is large. But other regions have different constraints. Europe may focus more on permitting, carbon policy, and grid congestion. Parts of Asia may focus on land limits, energy imports, and industrial policy. Some emerging markets may focus on power reliability and infrastructure financing. The common issue is not identical regulation. The common issue is that AI infrastructure requires electricity systems to adapt, and adaptation costs money. Here is the data point that makes the US case concrete. The US Department of Energy reported that data centers used about 176 terawatt-hours of electricity in 2023. That represented around 4.4% of total US electricity consumption. The same report projected a 2028 range of 325 to 580 terawatt-hours. That would represent approximately 6.7% to 12.0% of projected US electricity use. Those are national figures for the United States, not global figures. The local picture can be more intense in regions with high data center concentration, and that is why power plant deals matter. If a company can secure dedicated supply or help finance new generation, it may reduce some connection uncertainty. But if the structure is poorly designed, it can raise hard questions about fairness, reliability, and cost allocation. There is no serious analysis without that tension. The power is needed. The grid is shared. The costs are real. That is the issue. Now we can explain the control motive. Companies do not seek power or control only because electricity is expensive. They seek control because uncertainty is expensive. If the company cannot know when capacity arrives, it cannot plan compute deployment with confidence. If it cannot plan compute deployment, it may struggle to plan customer commitments, product timelines, and capital spending. A long-term power agreement does not eliminate risk. It can reduce some risk by turning a future energy need into a contract, project, or dedicated relationship. That is why large buyers are valuable to energy developers. A developer building new generation needs confidence that someone is likely to buy the output. A technology company needing electricity needs confidence that generation is likely to exist. A long-term agreement can connect both needs. That is the financial architecture behind many of these deals. The buyer provides demand certainty. The seller provides supply development or supply access. The grid, regulator, and community still matter. But the commercial relationship gives the project a stronger economic foundation. This is why AI companies can influence energy markets without becoming traditional utilities. They can act as anchor customers. They can make projects more financeable. They can give developers a demand signal. They can push older plants to stay open or new technologies to move forward. They can also create public concerns if local grids or communities feel pressured. Again, both sides are real. The business logic is rational. The public policy questions are also valid. That is what makes this topic worth studying. It is not a simple story of heroes and villains. It is a story of a new digital industry placing heavy demands on physical systems. And when physical systems are scarce, control becomes valuable. That principle is bigger than AI. Commodity companies understand it. Energy companies understand it. Logistics companies understand it. Serious businesses study scarce inputs because scarce inputs shape margins, timing, and survival. AI is now teaching software companies that lesson at industrial scale. A trillion-dollar ambition can still wait on a transformer. Dry, but true. So where does this go? There are two credible futures, and both deserve serious treatment. The first future is the bottleneck future. In this future, AI demand grows faster than electricity infrastructure can expand in key regions. Grid connection delays slow projects. Equipment shortages raise costs. Communities push back against land, water, noise, or rate impacts. Regulators become more cautious. Financing becomes harder if interest rates remain high or revenue expectations weaken. In that future, AI deployment does not stop, but the pace may become more uneven, more regional, and more tied to electricity access. The second future is the infrastructure boom future. In this future, AI demand becomes a major demand signal for energy investment. Utilities modernize grids faster. Nuclear restarts and new nuclear projects gain stronger commercial backing. Advanced geothermal receives more capital. Batteries become more important for data center flexibility. Transmission planning improves because large buyers are willing to sign long-term contracts. In that future, AI does not merely consume electricity. It helps accelerate investment into energy systems that were already due for modernization. Which future is more likely? The honest answer is that both can happen in different places at the same time. One region may face bottlenecks. Another region may attract investment. One project may be delayed by equipment. Another may move forward because it has a long-term buyer and existing infrastructure. One community may resist a large data center. Another may welcome one because of jobs, taxes, or new energy investment. This is genuinely uncertain, and anyone who gives one universal answer is simplifying too much. The better framework is regional. Study the grid, study the power source, study the contract, study the permitting environment. Study the financing conditions. That is where the answer lives. The AI economy may not be shaped only by who has the best model. It may also be shaped by who can secure the electricity required to run the model. That is a much more useful way to see the next decade, and it is exactly why this trend matters. The deeper lesson is not only about AI. The deeper lesson is that big opportunities often hide a boring constraint. People see the high-status output. They miss the low-status input. In AI, the output is intelligence on demand. The input is electricity delivered at scale. In finance, people often see returns. They miss liquidity, collateral, credit conditions, and incentives. In business, people see revenue. They miss distribution, operations, cash flow timing, and supply constraints. The pattern repeats because reality does not care which element sounds exciting. Reality cares which component breaks first. That is the harsh but useful lesson. If power is the constraint, then power becomes strategy. If cooling is the constraint, cooling becomes strategy. If financing is the constraint, financing becomes strategy. If regulation is the constraint, regulation becomes strategy. This is how serious operators think. They do not study only the visible product. They study the input chain that makes the product possible. And AI is revealing one of the largest input chains in modern business. Chips matter, models matter, talent matters. But electricity may decide where capacity appears first. That is why the power plant story is not a side story. It belongs inside the main business architecture. And once you understand that, AI looks less like magic and more like industrial strategy. That is a more accurate view. It is also a more useful one. Here is a clean framework for understanding any AI infrastructure announcement. First, identify the compute need. How much capacity is the company trying to deploy? Second, identify the power source. Is the electricity coming from the grid, a PPA, on-site generation, nuclear, renewables, gas, geothermal, or a mix? Third, identify the delivery path. Can the power physically reach the site? Fourth, identify the timeline. Is the announcement about immediate power, future power, conditional power, or a project that still needs approval? Fifth, identify the cost allocation. Who pays for the generation, transmission, interconnection, backup, and reliability requirements? Sixth, identify the risk. Is the main risk construction, regulation, financing, fuel price, community opposition, technology maturity, or demand uncertainty? That framework keeps the conversation honest. It prevents hype from turning a press release into a conclusion. It also prevents fear from turning a real infrastructure challenge into a claim that AI cannot scale. The truth sits in the details. A 20-year agreement is different from an operating power plant. A planned reactor is different from a completed reactor. A data center campus near generation is different from a direct ownership claim. A corporate power agreement is different from electricity flowing physically from one plant to one building. These distinctions matter because imprecise language creates false certainty. And in finance, false certainty is expensive. So when you hear that an AI company is buying power, ask what kind of buying is actually happening. Is it ownership? Is it a contract? Is it a power purchase agreement? Is it a campus acquisition? Is it environmental attribute matching? Is it behind the meter generation? Is it front of the meter supply? Each structure means something different. This is the layer that most analysis skips. The headline says power plant. The financial reality may be a contract, a grid relationship, or a long-term demand signal. That difference is not small. It changes the risk, the timeline, and the business meaning. Precision is not decoration here. Precision is the whole point. To understand the power plant question, look inside the data center as a physical site. The first visible layer is the building, but the building is not the business by itself. The business depends on racks, chips, networking gear, storage, cooling, electrical rooms, backup systems, and operations teams. Those systems have to work together under tight reliability requirements. A server does not only need power once, it needs stable power continuously while workloads are running. It also needs cooling continuously because high-performance chips convert a large share of electrical input into heat. Heat then becomes another constraint. If cooling capacity is insufficient, equipment can throttle, fail, or operate below intended performance. That means electricity is not the full requirement. Usable compute depends on electricity plus cooling plus power quality plus redundancy. Redundancy is the reason data centers can look overbuilt from the outside. They may need backup generators, uninterruptible power systems, spare capacity, duplicated pathways, and detailed maintenance planning. The goal is not just to get electricity into the building. The goal is to keep electricity available when equipment fails, when demand spikes, or when weather stresses the system. That reliability standard changes the economics. A normal business can sometimes tolerate downtime. A large cloud or AI facility may face contractual, reputational, and operational damage if downtime appears at the wrong moment. So the power strategy is not only about the price per kilowatt hour, it is also about certainty, reliability, and control. Now add cooling. Some data centers use air cooling, some use liquid cooling, and some use mixed designs. As AI chips become denser, cooling design becomes more important. That can affect water use, electricity use, building layout, and site selection. A site with cheap land but limited water or weak grid access may not be attractive. A site with strong power but poor network connectivity may create another problem. A site with good power and connectivity may still face permitting delays. This is why the best AI infrastructure sites are not chosen by one variable. They are chosen by a bundle of constraints: power, land, fiber, cooling, tax rules, permitting, labor, and customer proximity can each matter. Here is the data center reality in plain English. The user sees a text box. The company sees an industrial facility. The utility sees a large load. The regulator sees a reliability and cost allocation issue. The community sees land, water, jobs, noise, and electricity demand. The investor sees capital spending and future revenue uncertainty. Same facility, different stakeholders, different concerns. That is why data centers become politically and financially complex. They are not just buildings with computers. They are electricity-intensive infrastructure assets sitting inside shared public systems. Once that becomes clear, the power plant deals look less surprising. A company that controls more of the input stack can reduce some uncertainty. It still cannot eliminate risk. Weather, regulation, technology performance, financing, and local approval can still matter. But dedicated power relationships can make one critical input more predictable. Predictability is valuable when billions of dollars are being committed before the facility is fully productive. That is the hidden economics. AI companies are not chasing power because power is glamorous. They are chasing power because unusable compute capacity is a costly outcome. And a delay caused by electricity is still a delay. The model does not care whether the bottleneck was boring. The business feels the delay either way. Now zoom out from the data center to the equipment that delivers electricity. A power plant is not enough by itself. Electricity has to be generated, transformed, transmitted, transformed again, protected, metered, and delivered safely. That delivery chain needs physical equipment. Transformers matter because they step voltage up or down so electricity can move across systems efficiently. Switchgear matters because electrical systems need safe control and isolation. Transmission lines matter because generation is often not located beside the load. Substations matter because they connect high-voltage networks to the local delivery path. Gas turbines matter when developers want dispatchable generation. Batteries matter when data centers need fast response and short-term flexibility. Each item has its own supply chain. And the IEA has already flagged tight supply chains for energy technologies such as gas turbines and transformers. This is why power availability is not just an energy resource question. It is also a manufacturing question. A country can have fuel and still wait for equipment. A developer can have capital and still wait for delivery slots. A utility can approve an interconnection study and still need physical components before construction finishes. This is where timelines become real. A chip order and a transformer order do not follow the same rhythm. A software update can ship quickly. A substation cannot be downloaded. That is the kind of sentence that sounds obvious only after somebody says it. And it is exactly why AI infrastructure is forcing technology executives to think like industrial planners. The procurement calendar matters. The permitting calendar matters. The construction calendar matters. The grid study calendar matters. The financing calendar matters. If those calendars do not align, the facility may not reach useful capacity on schedule. This is where the phrase artificial intelligence can mislead people. The intelligence may be artificial. The inputs are physical. Concrete is physical. Copper is physical. Steel is physical. Water systems are physical. High voltage equipment is physical. Skilled labor is physical. That sounds blunt because it needs to be blunt. The AI build-out is not escaping industrial constraints. It is adding digital demand on top of industrial constraints. And those constraints become more visible when demand rises quickly. This is also why some regions can attract data centers faster than others. They may have available land, existing generation, strong transmission, streamlined permitting, and supportive local policy. Other regions may have demand but weaker delivery capacity. The difference can shape where AI capacity appears first. This is the quiet competition behind the visible competition. Not just which company has the smartest model, which region can host the infrastructure required to run it. That question is now a serious economic question. It affects utilities, construction firms, energy developers, landowners, local governments, and cloud customers. It can also affect households if grid investments change local cost structures. Again, the answer is not automatic. Policy design matters. Rate design matters. Contract design matters. Community engagement matters. A data center can be a valuable project or a public frustration, depending on how those details are handled. That is why precision matters more than outrage. The real story is inside the details. Now consider the local community. To the company, a data center may be an AI infrastructure project. To the local resident, it may be traffic, construction, land use, water demand, noise, or electricity cost anxiety. To the local government, it may be tax revenue, jobs, permitting pressure, and public backlash. To the utility, it may be a large load that changes planning assumptions. These perspectives can clash, even when each side is being rational. The company wants speed. The utility wants reliability. The regulator wants fairness and system stability. The community wants benefits without unexpected costs. That is why the public policy dimension cannot be ignored. If a data center requires new transmission, new substations, or new generation, the cost allocation becomes sensitive. If the data center pays directly for upgrades, the project economics change. If costs are spread broadly, households and businesses may object. If the grid is not upgraded, reliability concerns can rise. If the project is blocked, economic development benefits may disappear. There is no free answer here. There are trade-offs. The serious policy question is how to price those trade-offs transparently. This is where the AI conversation becomes more mature. Instead of asking whether data centers are good or bad, the better question is how they are integrated. Are they paying for the capacity they require? Are they flexible during grid stress? Are they helping finance new generation? Are they located where the grid can handle them? Are they improving local infrastructure or only consuming scarce capacity? Are the benefits and costs visible to the public? That is the level of conversation that regulators and serious operators have to confront. The IEA made a similar point in practical terms. It noted that data centers can create special affordability challenges because of large, concentrated loads and rapid scaling. It also noted policymakers have tools to manage affordability through smart integration and flexibility incentives. That is the balanced view. Data centers can create problems. Policy can reduce some problems. Poor design can make problems worse. Better design can turn some demand into useful grid investment. That is not a slogan. It is the hard work of infrastructure governance, and this is why major AI companies may prefer more direct power arrangements. Direct arrangements can offer more certainty than waiting for broad system upgrades, but direct arrangements can also raise fairness questions if they interact with shared infrastructure. The issue is not whether companies want control. Of course they want control. The issue is how that control fits inside a grid that many people depend on. That is the tension regulators are likely to keep facing. Private AI demand is growing inside public electrical systems. That sentence alone explains the political sensitivity. A data center can be privately owned. The grid it connects to is usually a shared system. A power plant deal can serve a corporate buyer. The grid effects may touch other users. This is why the next phase of AI may involve more hearings, more tariffs, more special contracts, and more public debate. That does not mean the build-out stops. It means the build-out becomes more negotiated, and negotiated infrastructure often moves differently from software. It moves through regulators. It moves through communities. It moves through capital markets. It moves through physical construction. That is a slower world than the screen suggests. Now look at the long-term contracts themselves. A 20-year power purchase agreement is not a casual expense. It is a way to connect a future buyer with a future or existing electricity source. The energy developer needs confidence that revenue can support investment. The technology company needs confidence that power can support compute demand. The contract becomes a bridge between those needs. The contract connects those two economic requirements. Without a committed buyer, some energy projects may look too risky. Without committed supply, some data center plans may look too uncertain. Long-term agreements can reduce uncertainty on both sides. This is why credit quality matters. A large technology company can be an attractive customer because developers and lenders may trust its ability to pay. That does not remove project risk. It can make a project easier to finance. Now connect this to nuclear restarts and advanced reactors. Existing nuclear plants can face economic pressure if market prices, subsidies, operating costs, or license conditions become unfavorable. A long-term buyer can change the economics of keeping a plant online. New reactor technologies face a different problem. They need capital, regulatory progress, manufacturing learning, and customer confidence. A large corporate buyer can help create that confidence. This is why AI demand is important beyond the data center. It can act as a demand signal for energy technologies that otherwise might move more slowly. But demand signal is not the same as completed supply. A signed agreement is not a working reactor. A project pipeline is not delivered electricity. A target is not operating capacity. These distinctions protect the viewer from hype. They also protect the analysis from cynicism. The agreements matter, but they are not finished infrastructure. The right view is neither blind optimism nor automatic dismissal. The right view is to ask what has actually been built, what has been contracted, what still needs approval, and what still needs financing. That is how institutional analysis works. It separates announcement from execution. It separates intention from capacity. It separates narrative from cash flow. And in this topic, that separation is essential, because AI infrastructure announcements can be enormous. The numbers can be large enough to overwhelm the viewer. Gigawatts, billions, decades, campuses, reactors, transmission. The way to stay grounded is to keep asking one plain question. What electricity becomes available, where, when, under what contract, and at what cost? That question cuts through most of the noise. It also explains why companies keep moving closer to power generation. They are trying to control the answer. Not fully, but more than they could through normal short-term electricity purchasing alone. This is rational for them. It is also important for the public to scrutinize, because when private buyers shape energy investment, public systems can be affected. The best version of this trend could accelerate cleaner, firmer, more reliable power. The worst version could create local cost disputes, delayed projects, and reliability pressure. Both outcomes are plausible in different places. This is why the two futures framework matters. The future is not one clean line. It is a set of regional outcomes shaped by contracts, regulation, technology, and execution. That is harder to say in a headline, but it is much closer to reality. And reality is what matters when billions of dollars meet physical infrastructure. The screen may feel digital. The capital is very real. There is one more layer that deserves attention. The economics can still fail. A power agreement can be signed, and the project can still face delays. A data center can be announced, and customer demand can still come in below expectations. A power source can look attractive, and construction costs can still rise. A company can secure electricity, and chip supply can still become the binding constraint. That is why this topic cannot be analyzed with one variable. Electricity is critical, but it is not the only constraint. Financing conditions can change. Interest rates can affect the cost of capital. Equipment prices can move. Construction labor can become scarce in high-demand regions. Local permitting can take longer than expected. Energy technology can perform differently from projections. Cloud customers can renegotiate demand if AI economics change. These risks do not invalidate the infrastructure thesis. They make the thesis more serious. The bigger the build-out, the more important execution becomes. This is where the AI story starts to resemble other industrial booms. Early optimism creates demand. Demand creates capital spending. Capital spending creates infrastructure plans. Infrastructure plans meet cost, time, regulation, and physical limits. Then the market learns which plans were realistic. That learning process can be profitable for some companies and painful for others. Nothing in this video requires predicting which public company wins. That would move into investment advice, and that is not the purpose here. The purpose is to understand the mechanism. The mechanism is clear enough. AI demand is creating a large need for reliable electricity. Large electricity needs create pressure on grids and energy supply chains. Grid pressure creates incentives for direct power arrangements. Direct power arrangements create new relationships between technology companies and energy providers. Those relationships can change how infrastructure gets financed. That is the chain, but each link has risk. If AI revenue grows slower than expected, some capacity plans may be questioned. If power projects cost more than expected, contract economics may become harder. If communities resist projects, timelines may stretch. If regulators change rules, business models may adjust. If new chips become dramatically more efficient, demand could shift in complex ways. If AI usage expands faster than efficiency improves, electricity demand could keep rising. This is why the best analysis stays flexible. It does not assume collapse. It does not assume automatic success. It tracks the constraint. Right now, one visible constraint is electricity delivered at scale. Later, the constraint may shift to permitting, water, financing, chip supply, or customer demand. Serious operators keep updating the constraint map. That is how reality works. It moves the pressure point. The public sees the headline. The operator studies the pressure point. In the AI power story, the pressure point is no longer hidden. It is showing up in power agreements, energy partnerships, grid debates, and capital budgets. And that is why this topic belongs in macroeconomics, not only technology news. So why are AI companies buying their own power plants? Because AI at scale requires electricity at scale. Because the grid connection timeline can be slower than the AI business timeline. Because large data centers need reliable, local, deliverable power, not just electricity in theory. Because long-term power agreements can reduce uncertainty for both technology companies and energy developers. Because energy access is becoming a component of digital competition. And because the AI boom is forcing software companies to deal with physical infrastructure. That is the clean answer. The more complete answer is that AI sits at the meeting point of energy, capital, geopolitics, technology, and regulation. A model may be digital. The infrastructure is not. It needs land. It needs equipment. It needs cooling. It needs grid connection. It needs long-term financing. It needs public permission in many places. More than anything else, it needs electricity. That is why the next phase of AI may be shaped by who controls scarce real-world inputs, not in a vague sense. In the literal sense of megawatts, substations, interconnection studies, generation contracts, and project finance. The winner is not assured. The timeline is not assured. The economics are not assured. But the constraint is now visible. AI companies are not just building models. They are competing for the physical ability to run them. And once you see that, the power plants no longer look strange. They look like the next layer of the AI business. Since you stayed until this point, you clearly care about understanding what sits underneath the headline. The videos on your screen now go deeper into the financial and macro systems behind major global shifts. If this analysis was valuable, subscribe for more videos that break down complex finance, economics, and infrastructure topics with clarity. Thanks for watching.